So number one, risk
Risk
control.
control.
Our motto is, if we avoid the losers, the winners take care of themselves. So, we don't go out hunting for elephants. We just go out, we want to have a large number of good investments. In fact, the Financial Times has a column on Saturdays called Lunch with the FT. And they took me to lunch in December at my favorite Italian restaurant in New York. And I said to the reporter, I said, eating in this restaurant is like investing at Oaktree. Always good, sometimes great, never terrible. It would be great to say we're always going to be terrific, but it's not true. Nobody can produce that. You don't even have to be good all the time. You're good almost all the time, great some of the time, but never terrible. And if you do that for a few decades, you'll have one of the greatest records in history. So risk control, consistency, not top decile, bottom decile, top decile, bottom decile, but around the middle all the time. And then in our experience, we pop up to the top in the bad times. When things go wrong, because of our emphasis on risk control, we're better prepared than most. So I think that's extremely important. Here is the return on your portfolio. Here is the risk of the portfolio. And here is the outcome. And basically what it shows is that at zero risk, we collect something called the risk-free rate, which is usually the rate on T-bills. And then from there, as we increase the risk, the return also increases. The reason it's dangerous is because this is presented as a linear relationship. And so, in my opinion, it gives the wrong idea. Because most people who are familiar with this, if you say, well, what does it mean? They say, riskier assets have higher returns. And if you want to make more money, you just take more risk. Think about it. Doesn't make any sense. If risky assets can be counted on for high returns, then by definition, they're not risky. So that can't be right. Something's wrong with that. The returns on the riskier assets should be expected to be higher. If they're not expected to be higher, nobody will make a riskier investment. You only do it because you have the incentive of a higher possible return. But the return does not have to come through. It does not have to be delivered. And that's where the risk lies. So if you go to Oaktree Capital and you look at a memo called Risk Revisited Again in 2016, what I did is I took some little bell-shaped curves and I stuck them on the line. Now, as you move from left to right, increasing the risk, the expected return increases. We're still working with the same underlying line in terms of the relationship. But now, the range of possible outcomes becomes wider, and the bad outcomes become worse. That's risk. That first line gave a misleading picture. This is risk. High expected return, wider range of possible outcomes, and some outcomes which are inferior. So this is what we do for a living. We make these decisions for a living. We happen to operate all along here, but mostly in the more aggressive parts. As I said earlier, nobody can produce returns that are always great. In fact, if you think about it, most people and most strategies have a bias. Either they have an aggressive bias or a defensive bias, and the aggressor does really well in good markets,
Yes.
but loses quite a bit in bad markets. The defensive investor does pretty well in the bad markets, but doesn't participate much in the good markets. It's very unlikely that anybody can do both for you, outperform in the good times and outperform in the bad times. Now, our bias is toward outperforming in the bad times. And everybody, the mantra for investors is beat the market, beat the market. I want to beat the market. I want to beat the market. Why? I've never had anybody tell me cogently why it's important to beat the market when the market does well. When the market does well, everybody makes a lot of money. Why isn't that good enough? Why do you have to outperform a market that's performing well? I think the time when it's important to outperform is in the bad markets. Everybody else is losing a lot. It feels wonderful to only lose a little. But if you can combine bad years in which you lose much less than the other person with good years in which maybe you do the same, obviously your long-term result will be a higher return, less volatility, and a higher comfort level throughout. And I think that the comfort level cannot be overstated, because the cardinal sin of investing is not buying something that doesn't work out. The cardinal sin of investing is getting out at the bottom. When the economy is doing well and the companies are reporting good results and the prices are rising every day, people get excited, they become optimistic, and they buy and buy more as the prices go higher. But then if something goes wrong and the economy and the companies start to do a little less well and the security prices are falling, people get depressed and they start to sell. And the lower the price goes, the more they sell. Well, my mother told me, buy low, sell high. But our emotion tries to make us buy high and sell low. This is the worst possible thing. And so the most important single thing is to invest diligently, patiently, over a long period of time. Allow compounding to work and don't get out at the bottom. If you can be what we call a contrarian and do the opposite, if you can get out at the top and invest aggressively at the bottom, that's the best of all worlds, but it's not easy. So if you merely can avoid getting out at the bottom, then you're ahead of most people.